Good afternoon, everyone. We'll start with lesson 4, capital structure. And with this topic, in this chapter, we'll cover two things, capital structure and capital structure theories. Let us understand the meaning of capital structure first. A company has, for example, a corporate has an option. A company always, for example, it needs some funds, for example 1 lakh rupees. Now it has got the option to get this 1 lakh rupees from in the form of debt, or in the form of equity, or in the form of preference shares. So the capital structure means, capital means long-term sources of finances. Capital structure means the structure of the capital, the components, various components of the capital in the firm's kitty. So what happens is, it may go for 20% equity, it may go for 20,000 rupees equity, then 50,000 rupees debt, and last 30,000 as preference shares. So the capital structure will be 2:5:3 for equity, debt, and preference shares. So this is known as capital structure. Capital structure, it refers to the composition of its capitalization and includes all long-term capital funds, with share capital, loans, preference shares, etc. Optimum capital structure, it refers to the safest and most economical capital structure, or the best ratio between various securities. Optimum capital structure for any firm can differ, of each and every firm will be different, and it depends on a lot of factors what will be optimum capital structure for that firm. Basically, it represents the most economical capital structure with the least cost of capital. Now, what are the features of optimum capital structure? It gives you profitability, return, less of solvency risk, flexibility. It gives you conservational. It has conservational approach. Control, it gives you control. Factors affecting capital structure decisions. What are the factors which affect capital structure decision of a firm? Business activity of the firm, the stock market, taxation, credit policy, level of competition, industry life cycle, size of business, age of company, form of organization. Form of organization means whether it is proprietorship, private limited, or public limited, what kind of organization it is. Stability of earning, whether it is a new company or an old company, whether it is having stability of income or not. Asset structure, what is asset structure? What is a component of fixed asset? What is a component of current asset? What is the component of non-current assets? So these are all factors affect the capital structure decisions. And what is the importance of capital structure? It reduces the overall risk. It helps coping up with the business environment. It helps in the idea generation of new sources of funds. So these are the importance of capital structure. Now the next topic, next very important point which we are going to discuss is EBIT EPS analysis. So what we do is, this analysis shows the effect on EPS at various levels of EBIT due to financial leverage. It analyzes the effect of various capital structures on the EPS of the firm. So what we normally do is, EBIT minus I is equal to EBT minus tax is equal to PAT, profit after tax, minus preference dividend is equal to equity earning, and equity earnings divided by number of equity shares is EPS. So for example, if you look at the first example, effect of financial leverage on EPS, assume that the fixed charges funds can be obtained at a cost lower than the company's rate of return on its asset. Then 100% equity finance firm will not have any debt, and hence EBIT into 1 minus T will be the because interest is 0, EBIT will be is equal to EBT, and EBT into 1 minus T divided by N will be EPS. Similarly, if there is equity and debt finance firm, then there will be I, and EBIT minus I is EBT, and EBT into 1 minus T is PAT, divided by N will be EPS. Now just assume there is equity, preference share also, and debt also. Then what will happen? EBIT minus I will be EBT into 1 minus T will be PAT minus preference dividend, then divided by N will be EPS. So this is known as EBIT and EPS analysis. Indifference point. It refers to the EBIT at which the EPS for two capital structure alternatives are equal. So there may be two capital alternatives where you have this is where you have in one component you have equity and some percentage of debt, and some other, the second alternative, you have equity and some more or less component of debt. And then we can go for EBIT EPS analysis, and we find out the EBIT at which the EPS for two capital structures is same, and that will lead to indifference point. Indifference point is the point where it doesn't matter whether you go for capital alternative 1 or capital alternative 2. But above indifference point, more of debt component will give you higher EPS, and below indifference point, more of equity component in capital structure will give you higher EPS. So this is indifference point. Now let us go to capital structure theories. The capital structure theories helps to understand the factors most important in relationship between the capital structure and the value of the company. The capital structure theories look into capital structure as a measure to affect the valuation of the firm. Now, what are the assumptions of capital structure theory? That there are only two sources of funds, equity and debt, which is having fixed interest. So debt is having fixed interest. The total asset of the firm are given, and there will not be any change in the investment decisions of the firm. 100% dividend payout ratio, hence no retained earnings. No retained earnings. The operating profits of the firm are given and are expected to grow. Business risk complexion of the firm is constant and is not affected by the financing mix. So even if you change your debt component, the business risk won't change. There is no corporate tax or personal tax. The firm has perpetual life. The firm is never coming to an end. The investors have the same subjective probability distribution of expected operating profit of the firm. So everyone is having the same subjective probability distribution of expected operating profit as same as firm. Now, capital structure theories, there are two kinds of theories: modern approach and traditional approach. Modern approach, there are three kinds of theories: a net income approach, a net operating income approach, and Modi-Gilani-Miller approach. Let us go for net income approach first. Net income approach was given by Durand. According to this approach, the capital structure decision is relevant to the valuation of the firm. The cost of debt and cost of equity are assumed to be independent of each other. The theory suggests increasing the value of the firm by decreasing overall cost of the capital, which is measured in terms of WACC, weighted average cost of capital. This can be done by having higher proportion of debt, which is cheaper source of finances compared to equity source. According to net income approach, decrease in financial leverage will lead to increase in weighted average cost of capital, and thereby the value of the firm will decrease, and vice versa. So what we can do according to this approach is we can increase the debt component in our capital structure, and it will lead to increase in the valuation of the firm. If you look into this diagram, in x-axis we have degree of leverage, and in y-axis we have cost of capital. KD is represented by cost of debt, KE is cost of equity, and KO is overall cost of capital. As you increase cost of debt, if you increase the component of debt in the capital structure, you look into it, that overall cost of capital is sloping down, and it will be equal to cost of debt after some time. So this is the effect of leverage on cost of capital under NI approach, national net income approach. What are the assumptions of net income approach? The increase in debt will not affect the confidence level of the investors. KD will be more, K is more than KD, cost of equity is more than cost of debt. No taxes. There are only two sources of finance, debt and equity. There are no source of finance like preference share capital and retained earnings. All companies have uniform dividend payout ratio, it is 1. There is no floating cost, no transaction cost, and corporate dividend tax. Capital market is perfect. It means the information about all the companies are available to all the investors, and there are no chances of overpricing or underpricing of security. Further, it means that all the investors are rational, so all the investors want to maximize their return with minimization of risk. All sources of finance are of infinity. There are no redeemable sources of finance. So every source of finance is irredeemable source of finance. So this is in net income approach. What we learned is we can affect the value of the firm by changing the capital structure of the firm and changing it to more of debt mix. Now, net operating income approach. It is given by Duran. Under this approach, the cost of equity is assumed to increase linearly with leverage. Thus, the weighted average cost of capital remains constant and the total value of the firm remains constant as leverage is changed. The NOI approach suggests that the change in the debt of the firm company or the change in the leverage fails to affect the total value of the firm. According to this approach, the weighted average cost of capital and the total value of the firm are independent of the capital structure decision or financial leverage of the company. As per this approach, the market value is dependent on the operating income and the associated business risk of the firm. Both these factors cannot be affected by the financial leverage. Financial leverage can only impact the share of income earned by the debt holders and the equity holders, but cannot impact the operating income of the firm. So value of the firm will be EBIT upon overall cost of capital. This is the valuation of the firm. And the value of equity will be total value of the firm minus value of the debt. So it says that by increasing the debt component, you cannot vary the overall valuation of the firm, because as soon as the debt increases, the leverage, the risk of the firm increases. What are the assumptions of my approach? There is no corporate tax. Debt equity mix does not affect the overall cost of capital. Increase in debt changes the risk perception of the investors. Overall cost of the capital is constant. It is dependent on business risk, which is also constant, and cost of debt is constant. So if you look into this graph, then on the x-axis we have leverage, y-axis we have cost of capital. KD is represented by cost of debt, which is constant. When cost of as soon as we keep on increasing the debt, then the cost of equity will be higher will increase because or the perception of risk increases with the risk with the debt component in the capital structure, and hence the overall cost of capital will remain constant. It will not change. Third one is traditional approach. It was advocated by H.R. Solomon and H.R. Solomon and Fred Weston. Midway between NI and NOI approach, also known as intermediate approach. According to this approach, the equity capitalization rate rises only after a certain level of leverage and not before. So, the use of debt not necessarily increase the KE. This happens only after a certain degree of leverage. The implications is that the firm reduces its cost of capital significantly with the initial use of leverage. Hence, through judicious use of debt equity proportion, a firm can increase its total value and thereby reduce its overall cost of capital. There is no one single capital structure, but there are a range of capital structures in which the cost of capital is minimum and the value of the firm is the minimum. In this range, the changes in leverage may have very little effect on the value of the firm. So if you look into this graph, the whole thing has been divided into three: stage 1, stage 2 and stage 3. In stage 1, the cost of if you look into this, cost of debt and cost of equity. So when you increase cost of debt in the initial phases, the overall cost of capital goes down. Then it remains constant after some at stage 2. And at stage 3, the overall cost of capital increases with the increase in the debt component. So this is the cost of capital behavior. What are the assumptions of traditional approach? Capital structure theories are based on certain assumptions as to analyze in single and convenient manner. There are only two sources of fund used, debt and shares. The firm pays 100% of its earning as dividend. The total assets are given and do not change. The total finance remains constant. The operating profits are not expected to grow. The business risk remains constant. The firm has a perpetual life and the investors behave rationally. Now, Modi Gilani Miller approach. It was advocated by Modi, Gilani, and Miller. It states that capital structure is irrelevant. It favors net operating income approach that KO is constant. The value of the firm is independent of its capital structure and determined solely by its investment decisions. Thus, it is immaterial to consider as to how liability side is bifurcated. So, Modi Gilani Miller approach says that it is immaterial when we are talking about the capital structure would be deciding factor while changing the valuation of the firm. Valuation of the firm is independent of capital structure and it is determined solely by its investment decisions, what kind of investment decisions the firm is taking. Assumptions are perfect capital market. Investors are free to buy and sell securities, are well informed. All securities are infinitely divisible. No transaction cost. Cost of debt is less than cost of equity. No corporate and personal tax. All investors are only price takers. The firm's investment schedule and cash flows are constant and perpetual. Efficient and capital market. Interest rates are same for borrowers and lenders. No benefit of debt financing except tax shield. Theory when there is no taxation. When there is no taxation, K is more than KD. The increase in the debt will increase the required rate of return in equity. With the increase in the level of debt, there will be higher level of interest payment affecting the cash flow of the company. Then equity shareholders will demand more returns. Thus, the increase in the cost of equity is just enough to offset the benefits of low cost debt, and consequently average cost of capital is constant for all level of leverage. Valuation of a geared firm. These are some of the formulas. Valuation of the geared firm is equal to valuation of equity geared plus debt, and valuation of geared is equal to valuation of unlevered firm, leveraged firm plus dt, and value of unleveraged firm is equal to E, and kg plus ku. Kg is equal to Ku plus Ku minus Kd into D upon valuation of EG. Valuation EG. Theory propositions. This is more important proposition. It proposes three propositions in theory. Theory proposition 1 is in this proposition the total market value of the firm and its cost of capital are independent of its capital structure. The total market value of the firm is given by capitalizing the expected stream of operating earnings at the discount rate appropriate for its risk class. So whatever future earnings are there, we discount it and we can get the valuation of the firm. In proportion to the rate of return required by the shareholders increases linearly as debt and equity ratio increase. The cost of equity rises exactly in line with the increase in gearing to precisely offset any benefit conferring by use of apparently cheap debt. And proportion 3, the overall cost of capital is the cutoff point for all the investment decisions. The overall cost of capital is completely unaffected by the debt equity mix. This implies complete separation of investment and financing decisions of the firm. Now, theory, Modi-Gilani Miller theory of arbitrage process. It says arbitrage process. What is arbitrage process? When the process in which there is difference in the price of commodity in two different markets, and thereby what sellers are doing, what business people are doing, what people will do is they will buy from the market where the price is low and they will sell it to the higher market till the time there is price balance between the two markets. Arbitrage process is the operational justification for an approach. Arbitrage is basically buying a security in one market and simultaneously selling it in another market at a higher price, profiting from the temporary difference in prices. The process balancing operation, which implies that security cannot sell at different prices. The hypothesis states that the total value of the homogeneous firms that differ only in leverage will not be different due to the arbitrage operations. Effect on taxes. The tax burden on the company will lessen to the extent the relief available on interest payable on the debt, which makes the cost of the debt cheaper, which reduces the weighted average cost of capital of the firm to lower where the capital structure of the company has debt component. When corporate taxation is introduced, the tax deductibility of debt interest creates value for shareholders via tax shield, but this is a wealth transfer from taxpayers. The value of the geared company equals the value of the equivalent ungeared company plus the tax savings. With this, we can study this one. The value of the geared company is equal to value of ungeared company plus G. So if you look into gearing this, look into this, weighted average cost of capital is decreasing when cost of equity is increasing, cost of debt is decreasing, and cost of debt is constant, and weighted average cost of capital is reducing. Value of the firm increases. Weighted average cost of the geared firm is equal to cost of equity into percentage of equity plus 1 minus T into cost of debt into percentage of debt. Then value of geared firm is equal to value of ungeared firm plus tax benefit, that is dt. So with this we come to end of the 7th lesson. I hope you all enjoy the session. If you have any doubt, you can definitely contact me. Thank you.